Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Here's what's coming up on today's programme. Energy impasse, EU efforts to strike deals on price caps for gas and Russian crude stall as divisions push approval of some measures into mid-December. Oil trades little changed. COVID alarm, China's daily case count tops 30,000. That's for the first time, with parts of Beijing seeing panic buying as officials struggle to contain outbreaks across the nation. And Black Friday gloom, retailers brace for muted shopping results while thousands of Amazon warehouse workers across 40 countries plan protests over pay and working conditions. Let's check in on these markets then. It is a little bit muted. There is a bit of lack of direction. Of course, traders coming back to their desks in the US for a partial day of trading. You have got money moving in to US Treasuries. You're seeing that across the curve, yields down. Across these equity markets then, you're seeing losses in European stocks around 0.2%. The context is you've seen a grind higher since around the middle of August, so 6 weeks of gains, but taking some profit, at least on the margins of European stocks today, down 0.2%. S&P futures looking to hold above that 4,000 level, gaining at 0.2% when the markets reopen in the US after Thanksgiving. The Bloomberg Dollar Index, the dollar is currently unchanged. You've had 3 days of weakness as it helped fuel that modest rally that we've seen in stocks, and we'll work out whether or not that is likely to continue. We'll be talking FX just in the next couple of minutes. Given what we heard from the FOMC minutes and a step down maybe to 50 basis points in December. US 2-year currently at 4.44. That's a move lower by 3 basis points. As I said, money is moving into US Treasuries even as it moves out of gilts and bunds. Here's your map then as we shape up this Friday, 1 hour into the trading session. In terms of your sectors, by the way, at the top of the list is energy, just eking out gains of 0.2%. Utilities range bound. At the bottom of the list is real estate, down 2%, I should say. So across the regions, you're looking at just the UK that's holding into gains, the FTSE 100, just 0.1%, but you're seeing losses of 0.2 over in Germany, the DAX at 14,500, and the CAC going 6,700, just a drop there of 0.1%. Again, these markets appearing to look for catalysts after the importance of those FOMC minutes. We're going to have more data out, of course, next week, which will round out the picture. Let's get to what is happening in the FX world, because the dollar has been so important to the trends that have been shaping up across these markets this year. We're joined now by Elsa Linos, who's the global head of FX strategy at RBC Capital Markets. Elsa, thank you for joining us this morning. Happy Friday. Thanks for coming to the studio. Has the dollar turned?
A lot of people are ready to call it, particularly in Europe. So I've just been traveling around North America, and very striking how much more bearish European investors are on the US dollar. Personally, I think it's too soon to call it. Strategists are always itching to call turns, but typically they call 5 out of every 2 turns. So we're a little bit more cautious and waiting to see more meaningful direction lower in inflation before looking for the dollar turn.
So it's the inflation, it's those CPI prints that you need to see meaningfully lower. Is it kind of below 7%? Is it the rate, the level, or the rate of decrease in terms of those CPI prints that are going to be informative for you when it comes to whether or not the dollar has peaked? Currently down about 4% over the last month.
Yeah, so I think there's a widespread expectation, and reasonably so, that inflation will come down. The question is to what level? Because once we work through the commodity price base effects, and we can see it in the goods side of the equation that inflation is coming down materially, what happens with services? What happens with underlying inflation? And that's the key question for 2023.
Euro dollar, so many crosswinds for the euro. I just wonder if you can shine some clarity on the direction for the single currency. It's currently at 104. You have the energy story, you have the inflation, you have a recession. According to some of the economists we've been speaking to, possibly slightly softer recession than maybe some had expected earlier on in the year. The cross currents, what is the most potent mover of euro dollar in the months ahead as we look in towards the end of the year and into 2023?
So what's really interesting about the euro at the moment is that it lacks a lot of independent direction of its own. For a lot of people, it's just the anti-dollar. If you're bearish dollars, you might be long euro dollar, but you're not necessarily long euros. It's just the flip side of your bearish dollar position. I think, though, one key thing to watch is how US equities are going to perform in relative terms. And we've seen it happen at times, but not really materially take place. If US equities were to underperform in size, then you could see a lot more money being pulled out by European investors back into European markets, and hence some euro-dollar buying. That's
really interesting. I haven't heard that analysis before. So watch for US equities when it comes to your views on euro-dollar. Let's bring it to the UK then. And the pound has rallied this week. It's currently at 121, I believe. 120, 121 on GBP. 121, yeah, it's down a little under 0.1% in the session today. But it was a strong rally yesterday. Not all of that was down to dollar weakness. Have we seen a turnaround for the pound? Can it hold at these levels?
So unfortunately, and I say unfortunately because we're both obviously here in the UK, when you look at the longer term outlook for the UK, it's incredibly challenging. A lot of the deficits, the imbalances that have persisted are only set to get worse. We're relying on the kindness of foreigners to fund the current account position. The budget deficit is not going to materially improve until after the next election, if that. So weak pound does have to be the escape valve to suck in that foreign capital.
OK, and what levels are you looking at for the pound? Again, is it the 120 level? Do they go below that? What are you looking at in terms of the next level to hold for the pound?
So cable is actually a lot more about the US dollar than anything else. Euro sterling is the one that I'd be focused on. I think actually euro sterling has room to the top side next year. So I'd look for it to trade sustainably above 90. And that could be where you see those equity flows playing out in the European space.
OK,
Euro
sterling above 90. OK, we'll watch for that. Do you have a view on the Hong Kong dollar? Is this a red herring? Bill Ackman, obviously a big player. We all love it when someone like Bill Ackman tweets and he's got a short position on Hong Kong dollar. Is it a storm in a teacup?
We've seen a lot of movement in the vol curve in Hong Kong. It certainly feels like a storm in a teacup. Again, a little bit like strategists calling turns in the US dollar. A lot of people have called a break in the Hong Kong peg. Eventually, one day, it may break, but there's a lot of firepower to defend it.
Well, the other question is whether or not the yield curve control is going to break in Japan. Really interesting to see the inflation data out of Tokyo at levels last seen in 1982. Yes, Japan actually has inflation. Does that challenge the BOJ, or do we wait post Kurita or the governor when he steps down eventually in April of next year? Is it the next governor who's going to be consequential in terms of whether yield curve control continues?
So I think the Bank of Japan are far more likely to step away from yield curve control when the market is not pressuring them. Question is what that then means for the yen, because I think widespread expectation is the yen would rally hard on the back of that. I'd be a lot more skeptical. I actually think it'd be a great opportunity to sell yen on that knee-jerk reaction. And the reason being, the front end is not going to do anything. And as long as the Fed maintains rates up near these levels and Japan is stuck near zero, that dynamic is not going to change for dollar yen. OK, it's of course Governor Kuroda. I was combining Kishida and Kuroda for that aiming there. When it comes to commodity currencies, Brent off, you're looking at maybe at three weeks now of losses. How are you thinking about commodity currencies? China is a key factor in all of this. Do you want to be short commodity currencies until you get more clarity on China? So I actually think in the commodity space, we've seen some years of structural underinvestment and a very tight physical market at the moment. So yes, the initial optimism around the China reopening trade has certainly waned, and with good reason. That's not to say commodity currencies are a sure bet lower. And in fact, I think there are lots of opportunities to play commodity currencies into 2023, particularly if you think about the likes of New Zealand or Canada against, say, Sweden. OK, New Zealand, Canada versus Sweden. When it comes to Asia, what is the most important? Is it the yuan that's the most important currency to watch within that region? Is it the movements around yuan, or is it the linkages with the US dollar? So the linkages with the dollar have weakened over time. Critical, of course, what the China reopening story is going to be. I know it's obviously softened in the last few weeks, but there is a widespread expectation that in Q1 of next year, that reopening trade will resume again. And so that, I think, is going to send a far greater signal for the rest of the Asia complex. The problem, of course, at the moment is you don't have the yield that's on offer in some other regions of the world. Compare it to Latin America, the yield on offer in Brazil, in Mexico, and so on. It's just a very different outlook for the Asian currencies.
Any other crosses you would recommend at this point?
So we are actually looking at our 2023 trades, and I don't want to give it all away too soon. But certainly, I think there's opportunities to be short yen. We like long Swiss on the other side of it. OK, long Swiss, short yen. You haven't given it all away. You've given us enough, though. We'll get you back on next year to unpack all of that. Thank you very much indeed, Elsa Linios, of course, Global Head of FX Strategy at RBC Capital Markets. Right, coming up, the EU remains split over how to tackle the energy crisis, with plans to cap gas prices and Russian oil exports put on hold. We're going to have all the details next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie
in London. Now, the EU has paused efforts to approve an energy package that would cap the price of European gas and Russian oil exports. Deep divisions remain over the plan to address the energy crisis. Spain has been a harsh critic of the plan, but one of its ministers remains optimistic that a deal can eventually be reached.
There was something that was missing, this very important signal to the markets and traders. Of course, we need gas, but we cannot be sold at any price. So it was important to provide some inputs on how we can send this signal to the traders. And for the time being, the proposal of the Commission was not sufficiently effective. I would like to see this dynamic solution.
OK, for more on this, let's bring in Bloomberg's Maria Tadeo, who's at the EU Council building in Brussels. Maria, it was all about the price caps yesterday. Still no agreement on either a cap for European gas prices. Not such a big surprise there, but nothing also on the cap around Russian oil exports. So what happened?
Yes, Tom, and it's all caps and yet no caps. And you make a good point to make a distinction between the gas and the oil because they are running parallel, but these are two separate discussions. Now, when you look into the gas cap, essentially the issue here is the threshold for it to be triggered is a 275 euros megawatt hour for 2 weeks that the countries that want to see a price cap do not like. They say de facto this isn't one. It won't bring down prices. And at this stage, it's fundamentally the opposite of what they wanted to see with the price cap. When you look at the Russian oil situation, it's slightly different, but nonetheless, the sticking point, again, is the threshold, is the price. We're talking about $65 a barrel, potentially 70. But for some of the more hawkish countries on Russia, like the Poles, but also the Baltics, they say that at $65 a barrel, that is way too generous, and Russia still, they want to see that come down, and that's essentially where talks are now a deadlock. Having said that, we're being told that today talks will continue. Potentially, we do get this breakthrough. When it comes to the gas, however, we're going to have to wait for a few weeks until December 13th. That is when energy ministers will reconvene again, and I will be on this exact same spot, potentially talking about the same thing.
OK, two different parts of the energy mix, of course. So we're looking potentially then, you'll be monitoring this for us, of course, a breakthrough when it comes to oil. Gas, not until the middle of December, and you're going to be back on the ground for us. I think this is potentially a friction point that could become more tense maybe in the months ahead, and I'm keen to get your views on this, which is the division, at least the tension around and between the US and Europe when it comes to energy, and particularly that Inflation Reduction Act. How is all of that playing out?
Yes, and Tom, it's a good question, but also the two are extremely connected, and you can see why there's a thread that really connects the energy with the trade. And in fact, yesterday we had the energy ministers here in Brussels, and today we have the trade ministers. The concern for many here is that if you put together the energy prices, then you couple that with China, their aggressive industrial policy. On top of that, you get the Biden administration with the Inflation Reduction Act, which of course could be a real incentive for some of the green companies to move from Europe to the United States. They worry that the space they have to compete and stay attractive is becoming smaller and smaller. I spoke to the Czech trade minister. He said that pretty much every member state of the EU has a problem with the Inflation Reduction Act, but he also said we should not escalate with the United States. They are a partner in many ways, and we want to avoid a trade war. So it is a difficult balance here to thread.
Yeah, and no doubt they'll have memories of how their solar industry was crushed by the solar panel industry in China as well, and that will no doubt be in the back of minds. All right, Bloomberg's Maria Tadeo in Brussels following all the twists and turns, and we may possibly get a breakthrough on oil. We'll see later today. Maria will be on the ground for us. Now, China's daily COVID infections broke through 30,000 for the first time ever as Beijing struggles to contain growing outbreaks. The rapid spread of the virus has led officials to impose new restrictions across some of China's most important cities. For more, let's bring in Bloomberg's managing editor for Greater China, John Liu, who's on the ground in Beijing for us. John, COVID-19 then continuing to spread in the capital, more broadly across major cities in China, and so too the number of restrictions. Where is this all going?
Well, it's looking like it's going to be a rather challenging winter for China. The problem is that the government wants to both ease back a little bit on the COVID curbs to try and limit the impact on the economy, which has been severe. But at the same time, as they've rolled some of those controls back, it's contributed to what we've seen has been record levels of infections around China. Here in Beijing, there were 1,800 infections announced for Thursday. It's the most the city has had throughout the pandemic. It is pretty widespread throughout the city. Every district is reporting cases, and we have limitations placed on where people can go. Schools are closed, businesses are closed, and people are not traveling. They're not going out and buying or shopping. And so you can already see the sort of disruption like none that we've seen before.
Yeah, I was speaking to a contact on the ground there who's seen 4 of his staff taken off to central quarantine just in the last couple of days. John, in terms of food delivery services, so much enmeshed within everyday people's lives in China, is there a pressure point there? Are they overwhelmed, or are they able to get food into people's homes?
So it's been a bit of a sort of a contradiction. Food delivery apps have come to sort of a halt because the amount of demand has far outstripped their ability to fill those orders. So it's sort of a capacity constraint when it comes to couriers. At the same time, we've had several reporters go out and visit local grocery stores, and they remain fully stocked, relatively empty. One explanation might be that people, as you said, they don't want to get sent to central quarantine, and so they are avoiding going out as much as possible, risking potentially being identified as a close contact or even potentially becoming infected with COVID.
And John, this is the trillion-dollar question, really, for the global economy. Is there any sign after this 20-point plan that the Beijing is willing to kind of give up on COVID zero? What is your sense?
At this point, there is no indication that China is going to be moving away from zero as an objective. I think there are several ways to define zero. The clearest, I think, now is trying to get community spread to zero. So being okay with infections being detected in people who are in quarantine, close contacts, but trying to take the number of infections in the community circulating to zero. And as long as China wants to and aims to do that, the disruptions, I think, are unavoidable. That being said, I think in the longer term, after this winter, I think the country definitely wants to get out of this sort of terrible cycle of lockdown, unlock, lockdown again. How quickly it can actually do that, I think, is the big question. I think the answer as of now is it's going to take a rather long time.
It's going to take a while, and of course that is consequential for the global economy. Bloomberg's John Liu in Beijing with all the latest around those rising infections, what it means for those delivery companies, but also the outlook in terms of wrestling away from COVID zero. Thank you. Coming up, Black Friday in focus, of course. We're going to dig into retail and consumer spending on what is one of the busiest shopping days of the year. Stay with us. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance. Early edition. I'm Tom Mackenzie in London. A redhead breaking across the terminal around the Indian conglomerate Adani Enterprises, looking to raise $2.5 billion US. That is about 200 billion rupees via a further public offering of shares. The share price, as you can see, taking a knock on the back of that announcement. It's down 1.3%. So that's the redhead. Adani Enterprises looking to raise up to $2.5 billion with a new share sale. Right, let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Ukraine says it's managed to restore about half of its power capacity, knocked out by attacks from Russia, with water supply also back in Kyiv. In the US, President Biden says he's confident there will be support in the newly elected Congress for additional aid to Ukraine. This as President Putin's war reaches the 9-month mark. Nurses in the UK are to strike on 2 days next month in a historic walkout over pay. The Royal College of Nursing is demanding a 17% increase, which the government says is not affordable. It's the first ever national strike by nurses. Malaysia's new Prime Minister Anwar Ibrahim will test lawmakers' support for his leadership with a confidence vote on December 19th to prove he commands a parliamentary majority. Anwar was sworn in by the Malaysian king on Thursday night, cobbling together a unity government with the Barisan Nasional coalition. The monarch intervened after no alliance secured a majority in the election last weekend. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins, thank you. Let's briefly check in the markets then, about an hour and 25 minutes into the trading day. You're seeing losses across the European benchmark of 0.2%, but European equities are up, though. They've rallied since the depths around August the 17th and the highest level since August the 17th, I should say. Futures in the US pointing to gains of about 0.1%. As you can see, traders getting back to their desks for half a day of trading after the Thanksgiving holiday. The Bloomberg Dollar Index currently up 0.1% after 3 days of losses. And the US 2-year just to move there lower by close to 2 basis points, 4.46 on the 2-year. Coming up, we're going to be joined by Dean Forbes, CEO of Forterro. Stay with us. This is Bloomberg. Welcome back. Happy Friday. Your top stories today. Energy impasse. EU efforts to strike deals on price caps for gas and Russian crude stall as divisions push approval of some measures into mid-December. Oil trades little changed. COVID alarm. China's daily case count tops 30,000 for the first time, with parts of Beijing seeing panic buying as officials struggle to contain outbreaks across the nation. And Black Friday gloom. Retailers brace for muted shopping results, while thousands of Amazon warehouse workers across 40 countries plan protests over pay and working conditions. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Tom Mackenzie in London. I just want to update you on the oil story then, because in fact what you're seeing when it comes to Brent and WTI are pretty solid gains within the oil space. So we'll update that headline for you next time. $86 a barrel on Brent. That's again a 1.2%, almost 2% gain for WTI. Just below $80 a barrel. $79 per barrel for WTI. Right, let's get back to another story around the SMEs software. Really important in the context of what's happening with the global economy, but also what's happening within the tech space. My next guest was named the most influential black man in Britain in this year's Power List, beating none other than Marcus Rashford and Stormzy and Idris Elba. Homeless twice as a teenager, he's now CEO of the tech unicorn Forterro, which provides software solutions to more than 11,000 small and mid-sized manufacturing companies, not just in the UK, but across Europe. He also advises the private equity firm Corton Capital on its technology acquisitions. There's a lot to talk about with Forterro CEO Dean Forbes. Welcome to Bloomberg. Thanks for coming on set. Brilliant. Given the scope of your business, I don't want to start by getting a kind of a gauge of what you're hearing from clients. More than 11,000 SMEs across Europe. We talk every day about recession risks. You have your finger on the pulse when it comes to all of these clients. What are they saying to you? What is your sense of caution, trepidation? Is there concern, is there fear amongst your clients, or are they using this as an opportunity?
I wouldn't describe it as fear, Tom. What we've certainly seen is a number of clients are a little more cautious. They're taking a bit longer around CapEx and OpEx investments, but we're still seeing customers make good investment decisions. They're spending on technology because it is an opportunity to further automate and digitize the workforce and the business processes, and there are savings in that, right? There's opportunity for optimization in that. So yeah, not fear, but there's certainly an element of caution.
Because you've moved to a subscription model for the software business.
Right.
How is that process going? And are you seeing any clients, even if there isn't fear, are you seeing clients walking back their subs? Are they pushing back in terms of pricing? Is there any reluctance in that kind of area as you look to expand the business?
Well, certainly cash flow is king, right? The debt markets are out of control. The cost of debt is significantly higher than it was a year ago. And I think that's where the caution comes from. But moving customers to a subscription model or into the cloud actually takes away an element of investment and cost that they shift from their own balance sheet into OpEx. So that, again, is an opportunity for them to conserve a little bit of cash, de-risk the business, and push some of that responsibility for IT onto suppliers like us. And
you're still adding clients in this environment?
Oh, absolutely. Over the last year, we grew 11%. Not as much of that came from net new logo wins as we would have liked. Comes back to that caution element, but we are adding new clients. We're seeing existing customers expand just a little bit slower than they had done perhaps 24 months ago.
Do you see that trend continuing into 2023?
Yeah, I absolutely expect it to continue into 2023. I don't think we'll be through the worst of the recession by then. I don't think inflation would have changed materially by then. So we do see that caution and slightly slower pace continuing into 2023. But again, it's caution, it's rhythm, it's cadence. It's not fear. It's not people coming to abrupt halts.
And you've had long experience within the tech sector. We talked about the fact that you're an advisor on a PE or VC firm. So you have deep knowledge of this. When you look at the layoffs across tech, a lot of it's happening, of course, in social media. You're seeing that with the likes of Meta, Twitter, but also in terms of payments, Stripe, for example. How much more bloodletting do you think there is? How far does this go in terms of layoffs across the tech sector?
Well, I think it's, first important to realize that most of these layoffs at scale are happening in the supers, right? They're happening in the Metas, they're happening in the Facebooks, they're happening in Twitter. And to a degree, it's just kind of right-sizing, right? Let's look at Twitter. It's a huge company, huge revenue, but hasn't made a profit in all of its existence. So to a degree, this is an element of right-sizing. Now, the difficulty for software companies like us is that then flows down into our organizations, right? Those people who are looking for jobs, with higher salary expectations, they come into our market and they cause an element of compression among software companies like us. But we've seen this time and time again. We saw it in the dot-com, we saw it in 2008, and this is just part of the technology cycle that we go through.
Are you maintaining headcount? Are you adding? Are you cutting?
We're growing headcount next year. We expect to grow headcount, in the mid-teens. That would depend to a degree on how the markets behave, how our customers behave. But our outlook is still pretty good and pretty promising.
Okay, and you talked about that 11% growth in terms of client add-ons. You're looking ahead to 2023. You think those trends are going to stay? In terms of market share, it's a competitive space. You've obviously done very well. But as you look at expanding that market share, what is the target over the next 12 to 24 months?
Conservative. So our market grows between 8 and 9%. So growing above that is normally something that we would see as pretty good. We expect to grow at 11 to 12% next year. So very slightly ahead of the market. That isn't consistent across our space. We see some of our competitors shrinking and kind of battening back a little bit. So, we'll have to see. Our outlook is moderate, cautious, and we'll see how it goes.
Are you pursuing, is it organic growth that's the focus? You're a deal maker. Are you looking at organic growth or are you looking at acquisitions? Are valuations looking attractive to you? And how much dry powder are you putting aside?
Well, debt is, of course, a problem. As I mentioned, it's kind of 40% more expensive, but we're a good cash-generative business, so we will be looking at M&A. We've been hugely acquisitive in the past. I think a shift in the complexion of M&A is, great assets are less likely to come to market now, right? Investors will be patient if their business is good, still generating cash, and probably ride this wave out. So what we'll see come to market, and the opportunities that are probably going to be in front of us are for slightly lower quality assets where there's less cash in those businesses or reason to be concerned. It's that tone that will force people into doing deals in a market like this. So we just have to be careful at what we look to acquire.
That's really interesting. So still acquisitive, but you're saying the quality of those deals, the quality of those offerings may be a little lower than they were previously. In terms of your rapid expansion in that region, what other regions? Are you looking at the US? How big an opportunity is that for you, or Asia?
No, for us, we're super focused on the European space. So we'll continue to be acquisitive and look for growth in the European markets.
And within that sector, I mean, who are you supplying? Is it the industrials? Where is that demand coming from, particularly as these companies adjust and try and digitize? How much of a lag is there with these legacy companies? The SMEs that you're focused on, there's a lot of catch-up in terms of digitizing their businesses.
Absolutely, and that's what provides the opportunity for us. And another thing that provides that opportunity in a market like ours, supporting industrial companies and manufacturers, is a lot of them are looking to kind of bring manufacturing and elements of the supply chain back onshore, right? So previously they've depended on international partners for elements of the supply chain. They're looking to bring that, back into the home geography. So that again provides an opportunity to, digitize and bring software to deliver value across that chain as it comes back.
So the onshoring of supply chains is a catalyst for a business like yours. You're based here in the UK. Mm-hmm. To what extent has UK PLC been damaged by the politics of the last 6 months, or arguably the politics of the last decade? How do you see it? When you travel overseas, you meet with your clients. Mm-hmm. Does that weigh?
Well, we've seen the impact of our political situation on the markets, right, on the value of the pound. And when you travel internationally, especially into the EU, you have the kind of recent political landscape to deal with clients and suppliers. And you also have our situation relative to the EU to deal with those clients and suppliers as well. So it's made, you know, trading, it's made doing business just that little bit more difficult. You layer on top a recession and inflation, and it hasn't been a great situation in which to continue to try to grow your business.
Okay, Dean, thank you very much indeed. Really fascinating insights. Dean Forbes, CEO of Forterro there, a business that has at least over 11,000 SMEs across Europe, on the opportunities there for growth in this challenging environment more broadly for technology. Thank you. Right, coming up, McKinsey & Co partner Anita Balchandani on Black Friday. We'll dig into the differing retail trends. We're going to talk about inventories. We're going to talk about just how much appetite there is for consumers to go out there and spend in this cost of living crisis with inflation, and just what the deals are on these markets. That is Anita Balchandani coming up next. Stay with us. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Black Friday, it is here. One of the busiest days of the year for online shopping. Shoppers in the UK are likely to see disruption to their deliveries, though, as postage workers from Royal Mail go on strike. Amazon staff, meanwhile, are planning protests and strikes in over 40 countries over paying conditions as inflation takes its grim toll. We are joined now by Anita Balchandani, senior partner at McKinsey and retail sector expert. Anita, always great to talk to you when we've got a big retail story on our hands, and of course Black Friday is one of them. What are the changing trends that you're seeing in terms of retail, in terms of consumer demand this year versus previous years?
Tom, this is a Black Friday like no other, right? Consumer sentiment is at a record low. For example, in the UK, it's below what we saw during the 2008 financial crisis and at the height of COVID. And we do expect overall Christmas shopping to be muted, with 3 in 5 consumers saying they're going to shop less. That said, consumer intention to participate in Black Friday is really showing a step up. 70% of customers expect to be shopping today. That's 10 percentage points higher than last year. And it's particularly high amongst the younger consumers. But I think it is important to say that this increase in participation is also balanced by a much more value-conscious consumer that's going to be hitting Black Friday today. So the big step up that we see is consumers that actually are looking for spontaneous deals and wanting to lock them in. In fact, one of the reasons we've seen this year Christmas shopping being pulled forward, you could also argue that Christmas came before Halloween this year, and that's because the deal started earlier, but consumers have also been looking for deals, particularly to lock in prices and to secure the best prices with the anticipation of inflation. So I think it's all to play for, frankly, for Black Friday.
OK, so there's the demographics, maybe there's a more savvy consumer there as well, challenging these retailers. Is there a sense, Anita, are people trading down? Are they buying less? Are they doing a bit of both?
We do see some polarization in behavior here. So on the one hand, you very clearly have a flight to value and down trading. At the other end, you do see a flight to quality as well, and you see some of the luxury categories have been, relatively speaking, more resilient. So I think we're seeing that continued polarization or bifurcation in retail that's been going on for a decade. You see that, if anything, accelerated. But I think this Black Friday, we certainly will be looking at a more value-conscious consumer who's going to be checking out the deals and who's going to be voting in a way off the back of the value for money that they receive. So they can kind of really maximize the enjoyment of Christmas while still sort of, being conscious of tightened budgets.
And Anita, so that's the consumer. In terms of the retailer, what are we seeing in terms of the ability to pass on costs and preserve margins? Or are they in a rush to kind of offset and unload built-up merchandise and inventories?
Look, retailers are really sort of, managing the situation tightly and doing a combination of things. Many, as we know, have embarked on productivity measures, etc., to mitigate against inflation impacts. That said, the inflation headwinds are so substantial that price rises are inevitable. What we have seen this year is a step up in the level of promotional activity. So if you look at the fashion category, for instance, in October, 40% of the assortment typically was already on discount. What we also see is the days before an item goes from full price to discount is typically sort of gone down from, roughly 100 days to around 70. And we're also seeing sort of retailers looking to sell through earlier.
Okay.
So we also saw more of Christmas came earlier and even starting in October.
Anita, we just have to briefly jump in and then I'll come back to this conversation. There's a redhead on the Bloomberg terminal for our viewers, and this has been anticipated. This is the authorities in Beijing cutting that reserve requirement for the banking sector. So the China PBOC there, the central bank, of course, cutting the bank's reserve requirement ratio by 0.25%. You're looking at the yuan there, currently down just about 0.2% versus US dollar. Yes, this has been flagged, but this is just a reminder that, yes, the PBOC and the finance minister, this is the PBOC, of course, in terms of the action, but both arms of that government looking to support this economy now continually under pressure as a result of COVID-19. We're looking at record cases. The PBOC also vowing, and this is a line on the terminal, to step up implementation of prudent monetary policy. The PBOC cutting the RRR, it says, to release about 500 billion yuan in terms of long-term funds. So clearly keen to get that funding into the banking system and from the banking system into the beleaguered real economy that is China. Let's get back to the retail sector then. That is the redhead when it comes to China. We had expected it, but nonetheless, it is significant that they are stepping up support for this economy. When it comes to the retail sector then, Anita, and you were talking about the changes in terms of price cuts and discounting, what about the strength of luxury? The luxury sector has held its head up high this year. Year to date, it's done very well indeed. There has been the deep-pocketed consumer that's been coming to the rescue of that sector. Does that continue, or is luxury looking fragile in this environment?
Look, so far you're exactly right. The luxury sector has been, relatively speaking, more resilient. And in Europe also benefited from travel, and particularly travel in from North America, Middle East, etc. That said, I think if you look at some of the barometers or the signals, we're certainly seeing that the level of promotional intensity in luxury this year is starting to step up. We do think even within luxury, you have lots of different tiers of luxury. You have ultra luxury right up to accessible luxury. And I think we're seeing that right at the very top end of luxury, much more resilience in demand. But as you sort of go through some of the other sort of tiers of luxury as you will, we do see some signs that, of promotion and discounting activity and the need to activate demand in those segments.
OK, Anita Balchandani, Senior Partner at McKinsey, thank you for doing a deep dive in terms of the trends, the shifting trends from the retailer to the consumer on this Black Friday holiday. Thank you. Let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Hi, Tom. UK power company SSE has agreed to sell a 25% stake in its electricity transmission grid business to the Ontario Teachers' Pension Plan Board for about £1.5 billion. The network helps transport energy from the north of Scotland to demand centres further south. The move comes after SSE rejected a proposal from activist investor Elliott to split the company in two by separating its renewables business. Elon Musk says Twitter will vastly expand the reinstatement of banned users from next week. That's after more than 70% of participants voted in favour of a general amnesty for suspended accounts in a poll organised by the company's new owner. Meanwhile, Twitter has now lost its final 2 employees in the regulatory hub of Brussels, just as it faces increasing scrutiny from EU lawmakers. 6 people were previously employed in the office. The account of the latest ECB meeting shows some officials wanted a smaller 50 basis point rate hike in October to combat record inflation. Those favouring a less aggressive move pointed to other measures that came with the hike, including adjusting the terms of cheap financing for banks. However, ECB Executive Board member Isabel Schnabel warned in a speech in London it may be too soon to scale back rate hikes. That's your Bloomberg Business Flash. Tom?
Alice, thank you very much indeed. Just recapping the redhead that crossed the terminal. Yes, the PBOC, the People's Bank of China, upping its support for that economy with a cut to the triple R for the banking sector, the reserve requirement ratio being cut by 0.25%. We had expected this, but it is a significant move. They often do it on Fridays, and it's a reminder of the need for officials in Beijing to step up to support this economy. And as if to emphasise what is happening in terms of COVID, another headline crossing, Nanjing, a city in southeastern China, a city, by the way, of 8.5 million people. They're going to be testing the whole city for 5 days from November the 26th in terms of the COVID outbreak there. And this triple R cut is going to kick in early December. That is the redhead across the terminal in terms of the PBOC, the support for that economy. Right, coming up, round one of the World Cup has finished. Every nation has played. We're going to have the key takeaways. It is England-USA, 7 p.m. UK time later today. Stay with us. This is Bloomberg. Welcome back. Economics, finance, politics, and a bit of sport. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Yes, the first week of the World Cup in Qatar is coming to a close. We've seen Saudi Arabia topple Argentina, Germany stunned by Japan, and the favourites, Brazil, have yet to miss the tournament, won yesterday with a spectacular overhead kick. Simone Foxman has more from Doha.
12 years of preparations, 12 years of investments for Qatar, and it's been put to the test this week at the World Cup. Overall, at least from an infrastructure perspective, Qatar has met this test. People have been using the metro to get to and from the stadiums. They've been flying in and out without much fanfare from the international airport, and the country's overall been able to manage hundreds of thousands more people here in this very small area than normal. That said, the event has not gone off without controversy, especially over rainbows, whether it be rainbow-colored armbands or fans trying to get into stadiums and unable to after wearing rainbow-colored attire. That's something we're going to be looking for, whether it be between the teams themselves and pushing back against FIFA, or whether it be those fans trying to get access to the stadiums today, especially with the game between Iran and Wales, because those Welsh fans, they wear rainbow-colored hats. Also, we're going to be looking to see if we see any more stunning upsets, the likes of Saudi Arabia, Argentina, or Japan, Germany, as we move ahead into the second match for all these teams as they try to get through the group stage onto the elimination rounds. And then the question mark continues. Do we see the focus grow more on the field, or do we see it stay around issues that are off the field as teams start to get closer to leaving this competition? In Doha, Simone Foxman, Bloomberg News.
Bloomberg, Simone Foxman there with the latest on the World Cup on and off the pitch. The markets, European equities down 0.2%, futures in the US range bound. It is England versus USA later today. I'm entirely neutral. Come on, England. Surveillance Early Edition continues in the next hour with Anna Edwards in London. This is Bloomberg.
Keeping unity in this situation is paramount. We cannot let Russia divide us on energy.
The proposal that's on the table now regarding the market mechanism is flawed. There is a lot of risk for damaging the energy security of supply and also for the stability of the financial market.
This is no time to walk away from Ukraine. Not at all.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kayleigh Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Europe split over a price cap on Russian oil. Some EU members warn against being soft on Moscow, while others are concerned the limit will be too tough. A record-breaking day in China. For the first time, the number of daily COVID cases goes over 30,000. Meanwhile, the PBOC is cutting banks' required reserve ratio to bolster the economy. And why Black Friday could be bleak. Inflation and sagging consumer sentiment may keep shoppers from spending the way they normally do. We'll get the US and global perspective. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Matt Miller and Kaylee Lyons are off today. Let us quickly check on the markets then. Let's get straight to the market action. And this is what we have for you from European equity markets, which of course are up and trading, and we're trading all the way through yesterday. We look forward to being rejoined with US equity markets later on today, just for half a day of trading stateside, but still there will be US presence. European stocks are down by 0.2%. The UK market goes up 0.1%. You can see the energy sector is gaining, and that is playing to the strengths of London, of course. So energy stocks up by 0.6%. We see that yields are going a little bit, yields are on the move today across Europe, going up a little across Europe. They have been decreasing, though, of late. That's been the general direction through November. So I just put in a couple of the bond markets, sovereign debt markets here in Germany and in France to give a sense of the most recent movement. Let's get through the FX markets, though, because there I want to linger a moment, as we've had news out of China, which isn't actually moving the FX market all that much, but it has been well flagged. So the dollar in general terms is stronger this morning, up around 0.25%, obviously dealing with the ebb and flow of Fed commentary over recent days and weeks. Then we have in here the offshore Chinese yuan. You can see there's not a great deal of movement, trades at 7.17. There'd been a lot of talk during the China session overnight in Europe about whether the PBOC would have to do more to support the Chinese economy. COVID cases climbing there, and we have heard in just the last 20 minutes that the PBOC is taking action. More detail on that in a moment. We've got an energy focus for you as well today. So Brent crude is up by 1.6%. Generally, the direction of travel in recent weeks has been downward, and we've been tracking the twists and turns of what the European leadership have been doing around energy prices broadly, gas and oil. We'll get to that conversation in a moment. Back to China, though. Tom Mackenzie, Bloomberg's Tom Mackenzie, joins me here on set in London to take us through all of the latest. Tom, very good morning to you. So let's start with the PBOC's response coming just 20 minutes ago.
Yeah, so this was flagged by China's State Council, essentially their cabinet, earlier in the week, and the cut to the reserve ratio is 0.25%. It brings it down to 11%. The reality is it pumps about $70 billion, the equivalent of about $70 billion into this economy that we know is struggling. Earlier this week, Nomura, for example, cut their forecast for 2023 growth out of China to 4%. Now, other measures have been taken, of course. Chinese officials are stepping up their measures to try and support this economy. For example, a package of measures around the property sector. We know the pain there has been acute, but also outlining this 20-point plan around trying to ease away from COVID zero. And we're seeing the complexities of that. So yes, it's been flagged. It's important. It's another step in the direction in terms of pumping liquidity into this economy. Whether it gets the real economy, from the banks to the real economy, when they're shutting down large parts of this country, it is another question.
Yeah, it's going to be really interesting to watch in the days and weeks ahead as we see COVID numbers climb in China. What is the market's reaction function to that? Yes. Because in recent weeks, there's been an expectation of loosening up, of change in policy, of a policy pivot from the Chinese authorities, and that had led to optimism about Chinese growth. When we're faced with higher and higher COVID numbers, how will the market deal with that? And that's what we've got this morning in the terms of the Chinese data.
Yeah, absolutely. And what you're pointing to is arguably unfortunate timing in terms of the policy response, bad timing. It would be another way to look at it. They did come out with this plan, and then they were hit at the same time as the plan with these rising COVID cases. So it just points to the complexities of removing and getting away from COVID zero. So you're saying, absolutely, top line, record cases in China. And it hasn't been announced, but there is essentially a lockdown across major parts of Beijing. I've been in contact with people there on the ground. One employer saying that 4 of his team members have been taken off to central quarantine. He was showing me photos of what is happening in central quarantine in grim conditions. There's a lot of anger on the ground in cities like Beijing. Another city, Chongqing, that's a population of almost 30 million people. Again, not officially in lockdown, but in all but name, it is. Again, a population bigger than the population of Australia. It is remarkable. Nanjing, this is a line that crossed a couple of minutes ago, population of 8.5 million. They're going to test every single member of that city, 8.5 million people, over 5 days. So the real struggle is there around trying to move away from COVID zero. They have the plan in place. They're not able to restrict it or implement it because of these caseloads.
And I had a lot of conversations with our colleagues in Beijing earlier about just how quickly you can lift the COVID restrictions and the healthcare system still cope. And we've seen in some locations emergency healthcare provision having to be put in place to try and cope with the numbers that are anticipated. Tom, thank you very much for joining us. Tom Mackenzie with the latest on what's happening in China, the COVID cases and indeed the economic policy response. Now let's get to the European stories around energy. Germany's Olaf Scholz doesn't want to start a new transatlantic trade war, and he's worried Emmanuel Macron may be stoking one. EU-US relations at the centre of the trade minister meeting that takes place today.
Supportive measures like Inflation Reduction Act, there is definitely a threat that some of the European production can be moved to, from the profitability and subsidy point of view, more favorable markets. U.S. is aware about our concerns.
Maria Tadeo joins us, our colleague outside the EU, or at the EU Council building in Brussels. Maria, let me ask you about what's going on with trade then. We just heard from the trade minister, one of the trade ministers in attendance. I set out a divergent set of views between Germany and France. This is a growing tension over the Atlantic, though, to do with what the Americans are doing on policy.
It is, Anna, because in some ways there is a real anxiety in Europe about the state of the European industry, how to protect it, but also potentially the real damage, the long-term damage that the war could inflict in some of the big industries in Europe. For a lot of the European ministers that we spoke to this morning, they believe they have been hit essentially by a perfect storm. You have the high energy prices, you have China with now an aggressive industrial policy, and on top of that, the United States coming in with this Inflation Reduction Act, which they worry perhaps is going to entice companies to move away, to relocate from the European Union to the United States because it's better for business over there. Now, a lot of critics will say what you see now in Europe is a result of bad foreign policy, bad energy policy that played out for decades. But nonetheless, that is a tension point in this meeting. And of course, it's also a difficult one to thread because these ministers will also tell you they do not want to trigger trade tensions with the United States in the context of the war in Ukraine because they are allies too on that front.
Yeah, absolutely. So we'll watch how that develops, how US domestic policy setting might forge some sort of European response or create concern in Europe. Now, it was all about price caps yesterday, but we still have no agreement on either a cap for European gas prices or a cap on Russian oil exports. What's been happening?
All caps, Anna, all day talk around caps, but in the end, we have no cap on either front. And again, just to remind our international audience, right now here in Brussels, you have two debates on caps. You have the gas cap, and then you have the oil cap, the Russian oil cap. And essentially, they're different, they run parallel, but the sticking point is very similar, is the price point, is the threshold. Of course, for Europeans on the gas, that threshold of €275 megawatt hour for 2 weeks in order for that cap to be triggered does not satisfy countries that want to see that threshold move and become a dynamic price point. And when you look at the oil, you have some of the more hawkish voices on Russia, like the Poles, the Baltics, who say at $65 a barrel, that is not going to punish Russia. But Anna, overall, what I would argue, however, is there's also critics that suggest this whole thing is noise. Caps are not really going to change anything. And if anything, we could see severe disruptions on the supply chain at a point in which the energy market is very tight, but also very fierce.
Poland clearly very close geographically to some of the fighting, to the fighting that's been taking place in Ukraine, and certainly has felt the effect of the huge refugee flows we've seen coming through from Ukraine. They're also very reliant on energy coming from the east. So what's Poland been saying in terms of this debate?
Well, Anna, the Polish, and this we really need to understand, they have a very complicated history with the Russians, the Russian Federation. Of course, we had that incident that happened last week where really feel the West was now standing very close to the brink. Remember the missile, the counter air defense Ukrainian that fell on the Polish side. But at the same time, they have been very outspoken in the idea that they stand with Ukraine, that Ukraine has to win the war. There's a lot of geopolitical tensions that they feel play out, and if Ukraine does not win the war, could reflect then for other Eastern European countries. And when it comes to migration, especially in the context of this terrible humanitarian situation that is going on in Ukraine with no electricity, no water, no heating, they are expecting more refugees to come in the winter. The temperature's already getting very cold in Ukraine.
Absolutely. We all watch the weather. Thanks very much, Maria Tadeo, joining us there in Brussels with the latest on what has been and what has not been achieved when it comes to agreement. They did agree on some of the other gas measures to do with joint purchase, but not on that cap, as she says. Now, from CZ to Cathy Wood, here's what a few of the key voices have been saying to Bloomberg this week, what they've been saying about FTX contagion.
actually reflect on the FTX situation, and I kind of blame myself for tweeting that too late.
A cryptocurrency exchange has to provide for its users is to not lose their funds.
Right now, we have, it seems, from FTX, $5 to $10 billion in creditors as FTX has filed bankruptcy. They will be making claims.
The only real surprise is that the big funds that invested in FTX, that their due diligence was that poor that they didn't realize this was going on. It's absolutely outrageous.
FTX leveraged their novel and native token FTT to boost their assets, and likely as collateral to access loans. Yeah. And with that money, they created sort of a really quick scaling in both their size and in their power and perceived authority.
As an industry, we let FTX got too big.
Joining us now, Bloomberg senior crypto editor Anna Herrera. Anna, one of the people we heard there was CZ. He was talking to us yesterday, of course, and we analysed a lot what he had to say about the FTX story. He also talked about the fund that Binance wants to set up. How has that gone down with markets? Has there been any reassurance through the conversations about creating that fund?
Not really. I think people are still a bit worried about contagion, and so saying we have a $1 billion fund is probably not going to cut it for them until we see if more shoes are going to drop, especially because we've had the U.S. holiday. So I think people, and a lot of the action has been in the U.S., so maybe people are saying let's wait and see once the week starts again if we'll have more contagion, and then perhaps we'll calm down or not, or we'll start investing again. But yeah,
and a lot of the focus seems to be on just how much of the money in the fund comes from Binance themselves and how much they can drum up support from others in the system. Let me ask you about those in this space who are trying to raise money at this point. It must be a really difficult time. I know you've been looking at Matrixport, which is a crypto lender, and it's seeking $1.5 billion. I mean, how easy is that going to be, or difficult will that be in this environment?
I think that's the valuation that they're trying to reach. They're trying to reach at a higher valuation than before. Of course, we had astronomical valuations during the bull market, and now people are trying to shore up their investments. That's what we're being told, that they're trying to save the companies they've invested in, and it's really not a great market. VC investments have fallen in crypto, so especially if you're a new startup, this is probably not a great time. So we'll see if they're actually able to raise at that valuation again.
OK, that was the aim. Let's see what they actually managed to end up with. Anna, thank you very much. Bloomberg's Anna Herrera with the latest details on the twists and turns in crypto this week. Coming up on the programme, we'll talk macro with Freya Beamish, TS Lombard chief economist. What does she make of the policy support or lack of it against energy prices in Europe? What difference will that make to the European economy? We had growth data out of Germany earlier. We'll also talk about China, and we will have a discussion about the strength of the consumer this Black Friday. Lisa Hooker joins us, consumer markets leader at PBOC. We will have a US and global conversation around retail, plus how Apple's reliance on China is growing perilous. Read more about the chaos in iPhone City in today's Big Take story. Look for that online or on the Bloomberg terminal. This is Bloomberg.
I do think that it makes sense on our side to be a little bit on the slower side compared to what we have done in the past.
Mandatory is price stability. So as long as inflation is well above 5%, we may need to continue.
Doing so requires raising interest rates further for as long as needed to put inflation back on a sustainable path towards 2%.
Although my bias is towards further tightening.
We will need to be mindful. Adjusting too little will leave inflation too high, and adjusting too much could lead to an unnecessarily painful downturn.
Because then we can see what happens in the economy as a whole, and to what extent what we have done really sort of takes hold.
If the economy develops differently to my expectation and persistence in inflation stops being a concern, then I'd consider the case for reducing bank rate as appropriate.
Central bank officials offering diverging views on the future path of rate hikes. It's been a busy week for central bank conversation, even as it's been Thanksgiving week. Let's get to a chart which is of interest and a conversation about it. This is to do with emerging markets and the softer dollar overlaid over EM debt yields. And this is interesting because, of course, the dollar is very influential on how difficult emerging markets find it to service their debt. And we can see interesting movements in tandem on this chart. Let's get to Anita Balchandani, who joins us, Bloomberg Managing Editor for Credit, who can give some insight into what's going on with emerging markets at the moment then. And really nice to have you on the programme. So we've seen some of these yields coming down just in recent sessions, and BlackRock has turned more positive on emerging market debt. Is this just a dollar call? How much appetite are we seeing for EM debt?
There's a lot of appetite for EM debt, and that's mostly because we've had an absolutely horrendous year for risk. We've seen yields shoot up so high to levels that we haven't seen in many, many, many years. And what we've seen now is because there is a softening of the rhetoric among monetary policies worldwide, we are starting to see people say, you know what, maybe it is time to go into more risky assets. Now, with EM in particular, what you have is this index, which is headed for its best month since, I think it's May 2020. And even then, that month was extraordinary. This is actually, if you exclude that massive drop in COVID, right? If you exclude that, this is actually the best month since 2009.
Okay, so it goes in conjunction, goes hand in hand with the appetite for risk assets that we've seen in recent weeks.
Oh, yeah.
But all this comes a little too late for some emerging markets, and Ghana is just today's example of emerging market that is struggling. A haircut being proposed there on debt holders.
This is absolutely it. You can't look at emerging markets as one big blob, really. There are so many little stories in there, and we've got a lot of pain points, and Ghana is definitely one of them. The original sin that basically led to a massive blowout in U.S. debt among emerging markets is basically now showing that there is a lot of pain there, and Ghana is one of them. They are looking into the possibility of a 30% haircut and the possibility of not paying some of those interest payments, which is a massive hit for people, because when you buy Ghana debt, you're buying it for those interest payments.
Yes, and so we'll see whether this the turn in the dollar that is much talked about at the moment, but not everybody believes in it, whether we've seen the peak dollar, whether that stands, because that has a big bearing, of course, on these emerging markets. Back here in Europe then, Daniel, let's talk about that. European corporate debt markets looking a little bit less distressed, yields coming in. I mean, this is all part of the same dynamic, isn't it? An increased appetite for risk.
That's absolutely it, and especially that index that we're looking at the safer names within Europe.
So investment grade.
Investment grade. And a lot of these bonds, they blew out not because the credit itself wasn't good, but it was because appetite for bonds wasn't there. And that's because we've been seeing rates going up. So naturally, you would sell off bonds. Now these names are looking very attractive again, and people are coming back in, rightly or wrongly, because we don't know if inflation really is slowing or if it's going to rise again. As you mentioned in your last segment, the issue with China and whether or not it's going to close down because of COVID again, that's the major factor here.
That's having a big impact globally then on all kinds of asset markets. Thank you so much, Anita Balchandani, joining us there with the latest on credit markets. For more market analysis across various asset classes, you can check out MLIV Go. That's the function to use on your Bloomberg terminal to find the Markets Live blog. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Keeping you up to date with news from around the world, here's the first word. In Ukraine, half of the capital's residents are still without power following a barrage of Russian missiles. The mayor of Kiev warns that limits on electricity will continue. President Volodymyr Zelensky says the situation with power is difficult across the whole country. In the UK, nurses plan to stage their first ever nationwide strike for 2 days next month. It's an historic sign of defiance in a dispute over pay. The British government has said that calls for pay hikes 5% above inflation are not affordable. A new report predicts the world economy will be as weak next year as it was in 2009 after the financial crisis. The study comes from the Institute of International Finance. It forecasts that global growth will slow to 1.2% in 2023. That's largely because the conflict in Ukraine risks becoming a, quote, forever war. And thousands of Amazon warehouse workers in about 40 countries will mark the Black Friday sales day with protests and walkouts. They're demanding better wages and working conditions in a campaign called Make Amazon Pay. Employees in the United States, UK, India, Japan and Australia are among those taking part. Amazon says it takes its role seriously on what it calls these important matters. We'll get analysis of Black Friday, the US experience, the global story shortly. We'll also talk to Freya Beamish, TS Lombard chief economist. How is she updating her view on China given the COVID threats and monetary policy response? This is Bloomberg. Welcome back. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Europe split over a price cap on Russian oil. Some EU members warn against being soft on Moscow, while others are concerned the limit will be too tough. A record-breaking day in China. For the first time, the number of daily COVID cases goes over 30,000. Meanwhile, the PBOC is cutting banks' required reserve ratio to bolster lending in the economy. And why Black Friday could be bleak. Inflation and sagging consumer sentiment may keep shoppers from spending the way they normally do. I'm Anna Edwards in London. Matt Miller and Kaylee Lyons are both off today, so let's have a look at where we are on the markets that are open. We will have stateside trading, of course, a little bit later on today, but a half day for many assets. Certainly equity markets closed for half the day. So the equity market picture here in Europe is looking a little lonely right now, just fairly flat on the Stoxx 600. Energy names doing better, up by 0.9% for energy stocks as we see the Brent price at 86.69. A little bit of movement on debt markets. Obviously, the trend in recent sessions, or the trend through November, has been for some of these debt yields to be coming down. Let's have a look at the FX markets and commodity space as well, because there is something to say about what's going on in China, even if it isn't having much of an impact on the CNH. You can see the offshore yuan in there at 717, not moving. But the announcement from China, from the PBOC, that it was cutting the bank's reserve requirement ratio by 0.25%, 25 basis points. It was well flagged, it was expected, so perhaps it was all priced in. And it is designed, of course, to stimulate the economy, an economy that is increasingly facing challenges around COVID. Joining us now with analysis, Freya Beamish, chief economist at TS Lombard. And Freya, we'll start there. We'll start on China. We've seen the PBOC response today, cutting the RRR for just the second time this year, in fact. So trying to put that monetary policy stimulus into the economy, increase lending. What can that kind of policy do in the face of another policy which might be operating in the other direction, and that is around COVID?
Yeah, and you could add to that as well the kind of general lack of desire to borrow, which is a kind of a structural issue that is, when you put those two things that you just mentioned together, is exacerbated by the COVID shutdowns and the problems surrounding COVID. I think this is really a country that has a problem with liquidity. They don't know how to create liquidity in this environment without depreciating the renminbi more rapidly than they are willing to allow. And that's a problem in terms of what we expect for growth next year. The way you can kind of forecast growth in China very simply is just to take the change in short-term interest rates and lag that by 2 or 3 quarters, and then lag that tells you what's going to happen to money growth. And then you lag that by a couple of quarters, and that tells you what's going to happen to nominal GDP growth. Right now, money growth is running at 5.8%. That's M1. That's very low by Chinese standards. We've seen a tiny bit of a pickup, but it's not going anywhere. Hence the reserve requirement ratio cut. And the second kind of channel for monetary policy at the moment, which is very underappreciated, is when they're issuing local government bonds, the special bonds. It's often the banks that are buying those, essentially kind of funded by the PBOC. So that's another way that the PBOC has been getting liquidity out into the economy. What we've seen now is that those quotas have been used up for this year. So this is a fresh drag that is coming into the economy in terms of the liquidity provision to the economy that's absolutely necessary for the turnaround. When we talk about the kind of the COVID side of it, there's 2 factors you have to bear in mind. the lack of ICU beds, and the kind of the lack of vaccination for the old age population. Only 2/3
and both
of
of
them
those, Freya,
vaccinated.
And both of those bits of information, a lack of ICU beds and a lack of vaccination for elderly people and effective vaccinations, those things are going to limit the speed at which China can reopen, I suppose. And importantly, of course, in the very immediate months, we're dealing with winter.
Yeah, absolutely. So kind of two-thirds of the old age population haven't been vaccinated yet, or at least they've had less than 2 jabs, and you need 3 in the Chinese case to really feel more confident. And there are kind of less than 5 ICU beds per 100,000 of population, and that's very, very low. So it's not just a kind of a control thing. It's also they can't afford to take the risks that have been taken in other countries, in more developed countries, but because they don't have the infrastructure to be able to deal with the waves of Omicron that are coming. So that really kind of, when you put together those two things that you headlined, the liquidity problem and the problems with COVID, it really suggests that this kind of rally that has started on the hopes of faster opening up is somewhat kind of overboard.
Let me ask you about inflation and the dynamics we're dealing with in Europe then, Freya, because it's clearly supply chain issues, some of that starting with COVID, but long-lasting, long-living and still being endured by some. But adding on to that, of course, the energy crisis, and we have very elevated levels of inflation in many markets. And Europe, we get the Eurozone print next week for CPI, and I see there is an expectation on the Bloomberg that does tick down slightly. Do we have any sense that we've peaked in terms of the inflation story in Europe? I mean, the Bloomberg currently tells me the prior reading was 10.7. We expect the one next week to come in at 10.4. That's not much of a step down, but it would be something.
So one of the big shocks that we saw coming through in the inflation pipeline in October was the energy companies kind of actually bringing that through to the high street, and that in a sense could have been anticipated. There's a lot going on. But particularly for countries like Italy, that was where we saw the massive spike up, and it was about energy. So yeah, we should have the sense that this type of digestion of these shocks into at least the non-core items has peaked. It's not necessarily the case that the digestion of those non-core items into core has peaked, because there is actually a lot of pass through into the actual what we term as core. But actually is very, very much driven in many senses by what's happening in commodity markets. And in terms of the supply chain problems, they should be easing, but now we have these refresh problems in China, and I was slightly worried to see that manufacturing goods prices jumped up again month on month in October in China, and that could filter through unless it's a kind of a statistical blip. So we're looking at a slowdown in inflation, actually kind of at the margin, probably quickest in the US, although from a broader perspective, I have said that I think that's a kind of a mirage.
Yes, indeed. We've had that conversation. Thinking about the US, we're going to hear from Chair Jerome Powell next week. And what was interesting about the minutes was that other voices were amplified. We heard from other policymakers at the Fed, of course, and it seemed that there are more dovish takes around now, or at least than the market had anticipated. What risk then is there to the markets next week when we hear from Powell himself? I suppose there's a risk that he reignites that hawkishness.
I think so. I think we're coming now perhaps to the last hawkish surprise, but that surprise hasn't quite happened yet. So whether it's kind of 75 in December or 50, it seems likely that Powell and those around him are going to want to try to keep financial conditions still tight. And if they go 50, then financial conditions can start to loosen again. And what we think the Fed is trying to achieve is this sort of like shock to the economy by actually getting real rates high enough to cause the recession. So it's not about inflation. I just said that I thought inflation was going to come down reasonably quickly. If you hold core goods prices flat and there's no input from transportation services into core, then you can get to 4% core annualized rates, three-month annualized rates by April. So that trajectory, we could bet that's where we're going. But the problem is that there's still some strength in the economy. And we're only just getting sort of anecdotal evidence at this stage that the labor market is starting to crack. What the Fed needs is 3 months of kind of weak employment, negative employment, before it's able to say, okay, well, we've done enough. And then when we see that happening, it's actually probably going to be the case that the Fed cuts more rapidly than people are expecting. So from where we're sitting, we're still more hawkish on the way up, but we're probably more dovish on the way back down again.
Freya, thanks so much for joining us. Freya Beamish of TS Lombard. Thanks for spending time with us here on Bloomberg TV. Coming up, we'll get to the retail story. We'll talk about Black Friday and the effect of inflation on the consumer. We'll be joined by Lisa Hooker, consumer markets leader at PBOC. She'll give us the UK perspective. We'll talk about the global phenomenon that Black Friday has become. But we'll also be live on the ground in the United States, where apparently people might already be shopping. Let's see. Kriti Gupta is live for us. This is Bloomberg.
What we're seeing is a return back to the 2019 pre-pandemic buying pattern for the holiday. That's why we're really saying, what does that mean for Thanksgiving? What does that mean for Cyber Week? What does that mean for the last 10 days before Christmas? So we're adjusting our plans to accommodate anticipated higher peaks.
Lots of festive lighting in that shot. The CEO of Macy's sharing his outlook for the holiday shopping season. Joining us now from Herald Square in New York, just outside Macy's, I understand, is Bloomberg's Kriti Gupta. Good morning to you, Kriti. I mean, it's morning for me. It's very much morning for you. And very much morning for the people who've already gathered at the shops around you to not start shopping, but to show their intent. Let's talk about the health of the consumer then, Kriti. They might be looking forward to some shopping, but how healthy is the consumer in the US?
Well, Anna, we've got some committed shoppers right here outside of Macy's. Some people are still actually going with the long old tradition of lining up and waiting for a lot of those purchases. That being said, though, this is important in the context of a potential recession on the horizon. Remember, Anna, I'm a markets gal. 2023 is starting to forecasted by all indications to already see that recession, the inflationary pressures catching up with the consumer. But right now, they are still spending. In fact, spending is supposed to grow over 2.5% year over year. That tells you that people are still shopping, but they're not doing it with their stimulus checks in this country, which was really the kind of driver of a lot of the spending last year. Instead, Anna, credit debt is back. You are starting to see people spend on a leveraged basis now that they actually able to do so, really using some of that stimulus funds from last year to get rid of their mortgages, to get rid of their loans, and that frees up some of that credit card spend for shopping.
Okay, and retailers will, of course, be hoping that this Black Friday sends them into the black. Kriti, how are retailers positioned for this one then? What have we been hearing already through the earnings story?
Well, today is a little bit of a litmus test for the entire holiday season. Remember, you do want the consumer to show up, and you want them to show up in force, because one of the issues right now that you've seen across the earnings story is simply that retail volume is actually low. The prices are high, and it's that price hike that has actually been helping the likes of Walmart, for example, or even Macy's. Where it's really taking a hit is Target, it's Nordstrom, and that's going to be some of the issues right now. That divergence that you're starting to see between wealthier clientele versus the lower income consumer. Can they all come together and really help some of these retailers navigate the higher commodity pressures, the higher inflationary pressures that, once again, you are seeing around the world? And right now, the jury isn't out yet. So Black Friday is going to be a great test to see, are we going to start seeing more and more spending through the holiday season?
Okay, and what about, so that's the story around the retailers. This is going to be an important litmus test. What about inventory levels? Because that's been something that we have been hearing more and more about from these retailers. And for some of them, this is a really important opportunity to try and get some of that inventory out the door.
Higher and higher markdowns, Anna. That seems to be the key, and you're starting to see that actually become the trend. In fact, that's why this Black Friday is expected to actually surpass levels that you saw even pre-COVID, even in 2019. One of the big issues, though, is to what extent does that become the Achilles heel for the likes of Macy's, for example? If you have higher promotions to get rid of that inventory, are you still going to make up on the bottom line? Nevertheless, from a stock market perspective, if you get rid of those inventories, the market will reward you. So it depends. Do you want to see maybe better profits for your shareholders, or do you want to see a higher stock price? That seems to be the choice for a lot of these retailers at the moment.
Kriti, thank you very much. Find somewhere to stay warm. Bloomberg's Kriti Gupta, resisting temptation to go shopping herself and giving us the latest on the US retail scene this Black Friday. Let's get a more global perspective, and in fact, get a perspective from here in the UK. Lisa Hooker joins us, consumer markets leader at PwC. Lisa, nice to have you with us on set here in London. So let me go to the UK story, and you've been doing some research around just how much appetite there is for Black Friday, because, you know, this started out very much as a US phenomenon the day after Thanksgiving. It migrated across the Atlantic Transatlantic some 10 years or so ago, maybe more. Do Brits still go for this?
Well, actually, despite all the headwinds we've got at the moment, we're seeing that interest has held up this year on Black Friday. And we're expecting about 60% of people to actually shop. And of those, about 25 are saying we're definitely going to spend. And the expectation is we'll probably spend about $500 million more than we spent last year.
Okay.
So there's definitely good interest.
So there's still good interest. And you've done a survey. You've got some data to back this up, of course. So from that survey data, who are the people who are most interested? Is it sort of a younger dynamic, or how does it break down?
Yeah, it is very interesting. Men are more interested than women, and it's particularly around electricals and for themselves, while women also around electricals, but also for the family. And the under 35s are the most interested, with about nearly half saying we're going to shop. So they, again, are thinking about treating themselves. It's a leisure activity, but also everyone is slightly prepping for Christmas.
Yes, and I mean, a few years ago, pre-COVID, we used to see queues outside shops, long lines outside shops, and in some cases, people being injured, trying to get into shops. I mean, have we seen the end of that? Has this sort of opportunity to do this online if you want to, has that removed that, or should we brace ourselves for similar images?
I do think it's become an online shopping journey in terms of the UK. So you're not going to see the same level of queues or fighting. And also, it's not really over 2 days anymore, it's over a couple of weeks. Having said that, there's more people actually this year do want to go back into shops to do Black Friday, because I think people just want to get out there and have a bit of fun.
Yeah, let's say no to the fighting. That doesn't sound like a good idea.
No.
What about, I mean, there are bodies who do research around these deals, and it certainly from a very UK perspective, sometimes they find that, you know, that it's not a great deal actually when you compare it to what the price was in the previous 12 months. I know Which does that kind of analysis. I mean, where are we on that kind of story? Is it really worth getting so excited about Black Friday?
I think some of these reports are quite harsh. No one ever says it's the best day of the year to buy. It's one of the promotions they do across the year. So we see them, you know, after Christmas, we see them in summer, and we see periodic promotions. So it is just a promotional tool, and the level of discount does generally vary depending on how much excess stock you think that you may have. And also, when you think about electricals go down in price over time anyway as the new range comes out. So it might not be the best offer across the whole year, but it is definitely a promotional period.
During COVID, of course, things were in short supply, and then we had a real inventory build across retail. Are we still, in the UK, are we still dealing with the unwind of that big ramp up in inventory, or have we worked that off? What's the sort of UK retail story?
It's actually really mixed across categories and retailers. So actually last year, because we couldn't get stock, there's some retailers that then stocked up before we really saw the hit of this cost of living crisis. And there were some who were a little bit more cautious. So it's not general. You probably see a correlation. Those who are discounting more are those that are carrying more of the excess stock.
And what about the strength of the UK consumer in the face of that cost of living crisis? You can't move for headlines around higher gas prices, for example. How much are we expecting that to limit people's enthusiasm for Black Friday and the holiday shopping season running up to Christmas?
I think actually one of the reasons people are interested in Black Friday is to plan for Christmas and also look for bargains to try and reduce the cost of Christmas. I do think it's going to pull forward sales from Christmas, and Christmas will be quite muted, and we're probably expecting that on things like festivities and presents there will be a reduction in the amount people will spend.
Of course, cost of living faces people who work in retail as well, and we've seen strike activity being talked about by various countries from Amazon workers. Is that something that we should brace for? Because I don't know whether the sector has been very unionised in the past or organised in a labour sense, but we're certainly seeing that from something like Amazon employees.
We are, and I think what that will do will repeat of what some of the things we saw last year, where people actually bought a bit earlier because they're worried about either the Royal Mail delivering the parcel or getting it from Amazon. So we haven't really seen this before, but I think it will encourage people to use Black Friday and be more prepared for Christmas.
OK, thanks so much. Thank you very much for joining us, Lisa. Lisa Hooker joining us there from PwC to give us the UK retail perspective. Now, coming up, the first week of the World Cup has finished. We have some key takeaways from week one. That's coming up next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Now, the first week of the World Cup in Qatar is coming to a close. We've seen Saudi Arabia topple Argentina, Germany stunned by Japan, and the favourites Brazil win yesterday with a spectacular overhead kick. Perhaps they are still the favourites. Simone Foxman brought us more from Doha.
12 years of preparations, 12 years of investments for Qatar, and it's been put to the test this week at the World Cup. Overall, at least from an infrastructure perspective, Qatar has met this test. People have been using the metro to get to and from the stadiums. They've been flying in and out without much fanfare from the international airport, and the country's overall been able to manage hundreds of thousands more people here in this very small area than normal. That said, the event has not gone off without controversy, especially over rainbows, whether it be rainbow-colored armbands or fans trying to get into stadiums and unable to after wearing rainbow-colored attire. That's something we're going to be looking for, whether it be between the teams themselves and pushing back against FIFA, or whether it be those fans trying to get access to the stadiums today, especially with the game between Iran and Wales, because those Welsh fans, they wear rainbow-colored hats. Also, we're going to be looking to see if we see any more stunning upsets, the likes of Saudi Arabia, Argentina, or Japan, Germany, as we move ahead into the second match for all these teams as they try to get through the group stage onto the elimination rounds. And then the question mark continues. Do we see the focus grow more on the field, or do we see it stay around issues that are off the field as teams start to get closer to leaving this competition? In Doha, Simone Foxman, Bloomberg News.
Simone Foxman there in Qatar, and I was there 10 years ago, and there were no public subways at all. Incredible infrastructure achievement, but as she rightly points out, a lot of controversy off the pitch and some controversy in terms of the scorelines on the pitch as well. That is it for the show. Just time to give you a quick check of the markets, though. Let's have a look at where we are on the European equity session. Of course, our US friends will be back today. They'll be joining us on the football field later on in Qatar. But in terms of market action, we've got the Stocks Europe 600 up by 0.2% this morning. We've got energy stocks gaining up by 0.7%. Let's move on and show you what's going on FX, because we have seen the dollar, well, in fact, the Bloomberg dollar index is just up 0.1% or so today. The yen is actually quite weak, down by 0.6%. The euro is pretty flat against the US dollar. We've seen not much movement in the CNH, the offshore yuan. That's despite the fact that the Chinese monetary policy authorities, the PBOC, they cut the RRR, the reserve requirement ratio for banks, so essentially meaning more money can get into the system, more loans can be made, and that should support the economy. The second time they've done that this year. The COVID challenges mount, of course, for the Chinese economy, and monetary policy authorities trying to do their bit to support the economy. Energy remains topical, along with trade over in Brussels. More from Maria Tadeo and the team on the ground in Brussels as we go through the day. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.